So you file for Social Security on Monday, you walk out of the office, or you close your browser tab, and it's done. Well, by Friday, you realize the decision costs you $150,000. So you run the numbers again. Well, those numbers didn't change. Nothing illegal happened. Nothing unusual happened. You simply claimed at the wrong age. Well, there's a break-even age that is specific to your situation. There's a survivor benefit calculation most couples never run. So in the next 14 minutes, both of those numbers become yours. Well, here's the one number that makes waiting more valuable than almost any investment your financial advisor has ever shown you. Well, Social Security pays 8% more per year for every year you delay past 62, up to age 70. Well, that's a guaranteed, government-backed 8% annual return. There's no investment product on the market that offers that combination. Not a bond, not annuity. Nothing comes with the same government backing lifetime guarantee and annual inflation adjustment built in. And the 8% compounds. Waiting from 62 to 70 does not increase your benefit by 64%. It increases it by approximately 77%, depending on your birth year and full retirement age. You see, Social Security is the only income source in your retirement that's guaranteed for life, adjusts for inflation every year, and requires nothing from you to keep arriving. But at the age you claim sets the monthly payment permanently. You cannot go back and unclaim. You cannot restart at the higher amount after the fact. So there's no appeal process, no correction window, no second filing. The decision that you make at 62 or 65, 67, or 70 is a decision you and your spouse live with for the rest of your life. And the range is significant. Claiming at 62 versus waiting until 70 is not a marginal difference. It's a difference of nearly 80% in monthly income, built permanently into every payment you receive. Well, that gap also affects your cost of living adjustments. When Social Security increases payments for inflation, it calculates the increase as a percentage of your current benefit. A larger base benefit means larger annual adjustment. The compounding effect of a higher base runs forward for decades. Well, most people who claimed at 62 lost between $50,000 and $150,000 in lifetime benefits compared to waiting. And there is one part of this decision that most couples never calculate at all. Your claiming age does not just affect your monthly benefit. It determines what your spouse receives every month if you die first. For some couples, that single decision changes the survivor's income by more than $1,000 per month for the rest of their life. So we'll run that number in a moment. And yet more than a third of Social Security claimants file at 62 and lock in the lowest possible monthly payment for the rest of their lives. See, the reason most of them do this is not because 62 was the right answer for their numbers. It's because no one showed them their numbers before they filed. What changes right now? Well, here's the exact math. And after the calculation, there is something most retirement articles leave out entirely. One group of people for whom claiming at 62 is actually the right answer. So if you claim Social Security at 62, you get a reduced monthly payment starting immediately. If you wait until 70, you get a significantly higher monthly payment starting 8 years later. The break-even is the age at which the total lifetime income from both options becomes equal. So here's the real numbers. Say your full retirement age benefit at 67 is $2,000 a month. If you claim at 62, you receive approximately $1,400 a month. That's about 30% permanent reduction. Now, if you wait until 70, you receive approximately $2,480 a month. Well, that's 24% increase above your full retirement age benefit. Now, the math. Claiming at 62 versus waiting until 70 means you give up 8 years of payments. At $1,400 a month, that's about 400,000 you did not collect while you were waiting. Starting at 70, you receive $1,080 more per month than you would have at 62. So divide the $134,000 that you gave up by the $1,080 extra that you now receive. That gives you 124 months, which is just over 10 years. Add 10 years to 70. That's your break-even age, 80. So let's say you live past 80. Well, waiting paid more. If you live to 85, the additional lifetime income from waiting is $64,800. And if you live to 90, it's about $129,600. And if you live to 95, it exceeds $190,000. You see, that's where the $150,000 figure comes from and why it is the conservative estimate for anyone in good health. So now, here's what most retirement articles leave out. Waiting until 70 is not automatically the right answer. For roughly one group of the people, claiming at 62 actually produces more lifetime income. Well, that group is people with serious health conditions that significantly shorten life expectancy. If your break-even age is 80 and your doctor has given you a realistic picture that suggests that you're unlikely to reach it, the math favors claiming earlier. More total income arrives before the break-even point than ever. Social Security was designed with that trade-off built into it. It's not a flaw, it's intentional. Well, this video is not pushing one answer. The right answer depends on your numbers, your health, and your household. The calculation gives you the honest picture. What follows are the three variables that determine which answer is yours. Variable 1 is your health and life expectancy. Before you treat that as a personal unknown, we'll look at what the Social Security Administration's own data shows. The average 65-year-old today lives to age 85. About 1 in 3 people who reach 65 will live to at least age 90. About 1 in 7 will live to at least age 95. If your break-even age is 80, and the average person your age lives to 85, the math is not a coin flip. For the majority of the people watching this right now, the statistical probability favors waiting. That's just a baseline. Use it as your starting point, then adjust for what you actually know about your health and family history. So if you're in excellent health with parents who lived into their 90s, well, the math strongly favors waiting. And if you have a serious health condition that your doctor has told you and that you'll likely shorten your life expectancy, claiming earlier may produce more total lifetime income. Well, that's the group I mentioned a moment ago. The math is honest in both directions. And the break-even age is not a guess. It's a number you calculate and then test against what you actually know. Variable 2 is your current income and your ability to bridge that gap. And most people are wrong about one specific part of it. Waiting until 70 means not collecting Social Security for up to 8 years if you stop working at 62. Well, you need income during those years. If you have pension income, a working spouse, or retirement savings that you can draw from without triggering significant tax consequences, bridging the gap is often feasible. If claiming at 62 is the difference between paying your bills and not, the math is secondary to your actual situation. You claim to. Well, here's a part most people get wrong. If you claim before your full retirement age and keep earning income above approximately $23,000 a year in 2026, Social Security will temporarily withhold part of that benefit. Not take it permanently, withhold it. When you reach full retirement age, they recalculate your payment upward to give back the months that were withheld. The earnings test does not eliminate the money, it defers it. But it affects your cash flow in the short term, and that matters for how you structure your bridging income. The Roth IRA withdrawals, part-time income, and the careful sequencing of which retirement accounts you draw from first can often make the bridge to 70 possible without depleting the assets you will need later. Now, the number I told you about at the start, well, the number that affects your spouse's income for the rest of their life, well, variable 3 is your spouse's benefit. This is a calculation most couples skip entirely. If you are the higher earner in your marriage, your claiming age does not just affect your monthly income, it determines your spouse's survivor benefit for the rest of their life. And here's how that works. When the higher earning spouse dies, the surviving spouse receives whichever is higher, their own benefit or the deceased spouse benefit. If the higher earner claimed at 62 and locked in $1,400 a month, the survivor benefit is based on $1,400. If that same earner had waited until 70 and was receiving $2,480, their survivor benefit is based on $2,480. The difference is about $1,080 a month, every month for the rest of the surviving spouse's life. So if the surviving spouse lives 15 more years after the death of the higher earner, that single claiming decision is worth about $194,400 to the survivor. One additional detail most people don't know. The surviving spouse can begin collecting survivor benefits as early as age 60, not 62, age 60. If the surviving spouse has a qualifying disability, that floor drops to age 50. This is why Social Security claiming is not a personal calculation. It's a household decision. The impact lands entirely on the surviving spouse, who on average lives several years longer. Most people who sit down to run the calculation discover one of three things. The first is that waiting strongly favors their situation. Their break-even age is lower than their likely life expectancy, and their survivor benefit math makes the case even stronger. And the second is that they genuinely cannot bridge the gap. Their income needs require claiming earlier. They understand the trade-off and they plan around it. And the third is that they are married to someone who has never thought about the survivor benefit calculation, and that conversation had not happened yet. See, any of those three outcomes is useful. The calculation does not guarantee the right answer. It gives you an honest one. And here's exactly what to do before you file a single piece of paperwork. Write these down as I walk through them. 5 steps. Step 1. Go to the SSA.gov and create your Social Security account if you do not already have one. It takes about 10 minutes. You'll need your Social Security number and a valid email address. Check your earnings history for accuracy while you're in the system. Errors are common and correctable, but only before you file. Step 2. Find your estimated monthly benefit at 3 ages: 62, your full retirement age, and 70. The site shows all 3 simultaneously. Write them down. Step 3. Subtract the age 62 monthly benefit from the age 70 monthly benefit. That's your monthly upside from waiting. Step 4. Multiply the age 62 monthly benefit by 96 months. That's a total benefit you give up while waiting from 62 to 70. Step 5. Divide the total that you gave up by the monthly upside. The result is the number of months until break-even. Add those months to your 70th birthday. And that's your personal break-even age. So write that number down. Now ask one question. Based on your health and your family history, is it more likely than not that you will live past that age? If yes, the math favors waiting. If no, or if you can't bridge the income gap, the math is secondary to your real situation. Well, either way, you now have the number, and you're no longer making this decision without it. So if you're married, pull your spouse's estimated benefit at the same 3 ages. Run the survivor benefit scenarios for both claiming ages. That comparison is the final input before you decide. The Social Security decision does not exist in isolation. It connects to your Medicare premiums, your Roth conversion strategy, and your tax brackets in retirement. All of those calculations feed each other, and getting the sequence wrong is very costly. Well, the next video, I'm going to cover the IRMAA trap. That's the income-related monthly adjustment amount. Why your Medicare Part B premiums could be nearly $490 a month higher than your neighbors, based entirely on what you earned 2 years ago. And the form that eliminates that surcharge for people who just retired is called the SSA-44. It takes about 20 minutes to file. Most people who just retired do not know that it exists. So if you're planning Social Security timing and Medicare enrollment in the same year, you need to see that video before you file anything. And before you close this video, here's one move that costs nothing and takes under 15 minutes. Log into your SSA.gov website, create your Social Security account if you have not already, pull your benefit estimate at 62, your full retirement age, and 70. Run that 5 steps I walked with you earlier. Write down your break-even age. Then look at that number and ask yourself honestly, is it more likely or not that you live past it? Well, if you're married, run the survivor benefit scenario before you make any decision, and check your earnings history for errors while you are in the system. Corrections before filing are straightforward. Corrections after filing is not that friendly. So that's the complete picture. Everything else is paperwork. And if you are within 5 years of your filing date, which side of that break-even calculation are you leaning toward? Claiming earlier to secure your income now, or waiting to lock in a higher number? Well, the next video is the IRMMA breakdown, the income-related monthly adjustment amount. And if you want to watch that video, subscribe now. This is Han Brown on The Han Brown Show. I'll see you in the next one.